You're 63, single, and working, and you've accumulated $400,000 in your 401k. And you're asking yourself, with everything that's going on, should I consider converting some of this money to a 401k? That's what we're going to cover with our time today. Thanks for joining us. My name is John Vandergriff. I'm one of the owners and wealth planning team lead here at Blue Ridge Wealth Planners, where we help people transition into retirement on a daily basis, creating plans for that. And also people that are already in retirement, helping them plan for the areas that are very easy to overlook and not include with what most traditional options will offer you whenever it comes to the financial advice that they provide. So one of those areas that we find more often than not that gets missed is the area of tax planning. And so that's why we spend a lot of time on these videos covering this, different scenarios, so that hopefully you can learn more about that, how important it is, but also include that in the financial plan that you have. So a couple things before we get started. If you like this content, we would ask that you would like it, share it with other people, subscribe to our channel so that we can send you more content like this. And if you have any feedback on these videos, make sure that you comment below and we'll try to get back to you with anything that we can. So, but then the second thing that I like to start off with these videos, make sure that you don't just act on this blindly. There are a lot of things that are unique to this specific situation that may not be relevant to you. You want to make sure you have all the facts on the table before you go about making decisions that affect your taxes. A lot of times we'll work hand in hand with our clients' tax professionals so that we have all the information before we make these recommendations. So with that being said, today we're looking at a situation. I'm 63, single, and working with $400,000 in 401ks. Should I convert to a Roth? That's what we're going to dig into. So as we said, in retirement planning, it's not just about investment. Sometimes that's the natural assumption, but really there's 5 main areas that we've got to plan for, and what we find is the more conversations we have, the more interconnected these things are. So having a plan for our income, having a plan for investments, taxes, healthcare, and family and legacy. And so for our conversation today, we're really going to drill into the income and taxes part of this conversation. So you see obviously the direct link there, but as you said, that doesn't mean that those are the only 2 things that affect one another. Those will just be where we camp out today. So for this situation, we have a single person, 63. They're making $65,000 a year right now in income and wanting to work for another 3 years until they reach their full retirement age. If you don't know your full retirement age, look at your birth year. Social Security has those resources there, and you can find when that time is. But that is a time where you get the benefit that Social Security is planning on you getting, but also you don't get any penalties if you file early. And so when this person reaches that, $2,500 a month is what they would get in Social Security benefits at that time. And so their current scenario, they have $400,000 that's accumulated in 401ks, $100,000 that they have inside of either banks or other after-tax positions, and then their goal is to generate $4,000 a month that they can live on in retirement. So as we look at this, all these things can come together and be very important in this conversation, because specifically we need to look at where income is today, where that income will be later, to determine some of the things that we talk about with Roth conversions. So as we look at Roth conversions, we do want to start here in a very fundamental way, because it is important to know that anytime you move money out of an IRA or 401k, that is going to be a taxable event. It doesn't have to go to a Roth to make it taxable. If you take it out and spend it, triggers a taxable event for you. The only way not to do that is if you take a loan out against your 401k or retirement plan. A lot of times you don't have that option if you're not working. But anytime that money is taken out and not through a loan structure, and IRAs don't have a loan structure, that would trigger a taxable event for you of whatever that withdrawal is. Now, Roth IRAs need to be in place for 5 years before you have completely tax-free distributions, and this applies to your contributions and any growth to that. When you have conversions that take place, that will restart a 5-year clock for that particular bucket, especially under the age of 59 and a half, because you would actually have a penalty on any of those converted funds if you took them out But if you get over the age of 59 and a half, if you do a conversion at that time, the principal that you convert is actually available during the 5 years. It's just the growth on that money would then be taxable to you if you didn't wait the full 5 years for it. So all those things are very important to factor in. This person being 63, they are over the age of 59 and a half, so they are able to do conversions without a penalty, and then also withhold taxes from those funds as well. So as we look at this and kind of dig into this particular situation, we've got $48,000 of income need that they're projecting at retirement, $30,000 of income sources at retirement time. You know, right now, as we said, you know, he's making, or her, doesn't have to be he, this individual's making $65,000 a year currently. So obviously that's going to stop when they get to retirement. So $30,000 and then a need of $18,000 a year will be what he would need, or she would need to pull from these funds to be able to make retirement happen, and then obviously have inflation and things factored in as well. So as we look at that, moving up here to the right corner, current annual income of $65,000 would put this individual into the top tax rate today for them of 22%. So we'll come back around to that of why that's important. And then, as we said, $400,000 in pre-tax, $100,000 in after-tax, $0 in tax-free accounts like Roth IRAs or properly structured life insurance plans. So this is not uncommon when we sit down with people for them to have a majority of their money in pre-tax positions. The goal, if the tax environment is appropriate for them, is to try to move those down into more after-tax and tax-free positions so that they can settle up the tax obligation that they have with that money. And so I always take this opportunity to explain why that could or could not be a good decision for you as an individual. Make that a little thicker. Because it's not a blanket recommendation for everybody. Not everybody is going to benefit from making Roth conversions today. So as we look at this, we do want to walk through what matters in this discussion, because I think a lot of people have not been trained appropriately when it comes to understanding taxes, and sometimes those people are actually giving advice not to do some things that could be in the best interest of the clients or the people they're giving that advice to. So we want to look at this from a unbiased position and just say, what does the math tell us here? Is it good? Is it not good? Well, depending on the situation, we'll find that answer. So what we're going to look at is two scenarios. If you leave an IRA or 401k tax-deferred account in place versus if you take that money and convert it to a Roth, what happens? So the easiest is if you don't do anything, the account stays as is, and then depending on your age, obviously this person being 63, they would have a 10-year runway before they would be forced to take this money out for a required minimum distribution. So right now they have no taxes. If they took that money out and converted it, as we said, $100,000 would add to their taxable income this year. And if that triggered a cost of 20%, and you pay that out of this money, then you would have $80,000 that you would start the Roth account with. Some people will stop here because there's a noticeable difference in these two numbers. Some advisors will actually use this alone as a basis for not doing Roth conversions. I think that's short-sighted because we're not looking at the same buckets of money. Now, they may have good reasons. They may say, oh, well, when you look at these two buckets, and the market goes up, let's say 10%, this account's only going to make 8, this side's going to make 10, you're making less money, you shouldn't do this. Well, again, we're not looking at the same buckets here. Depending on the tax environment, that $8,000 of growth here could actually be more beneficial to you than the $10,000 of growth there. So we've got to play this story out a little more to see truly from a tax perspective what matters. So double these examples. We got the IRA goes to $200,000. The Roth account doubles to $160,000. If we assume that they're invested the same way, this helps us take care of inflation concerns. In this, and again, sometimes we try to include things in this conversation that have nothing to do with the taxes. Rate of return on your money, again, it's going to be the tax percentage that we're really focusing on, and you're going to see that in just a second. So with the Roth, assuming that this period of time is longer than 5 years, we know that the growth and the withdrawal of this money is going to be zero tax to this individual. And so you got $160,000 here free and clear of taxes. The $200,000 that's accumulated in the IRA depends on the tax environment when the withdrawals take place. And so if you're 63, you don't take anything out, you're going to start being forced to take it out in 10 years and then taking a little bit out every year for the rest of your life. So if the tax environment at that time is the same as it was at the beginning, what you will notice is the bottom line numbers are exactly the same. So again, we've got to recognize that if the taxes never change, it doesn't matter whether your money is in a tax-deferred or tax-free position, your bottom line numbers are going to look exactly the same. Now, this goes against a lot of the way that people give advice about retirement, because most people are convinced that you will not show more income in retirement than you do while you are working. I have several clients that contradict that, because when they have pension, Social Security, and forced RMDs, sometimes they have more income in those retirement years than they've ever had in the rest of their life. But if you are one of the people that's income goes down in retirement, the thought is lower income means a lower tax. Well, you may pay less dollars of tax, but the percentage that you pay is what we're focused on. And no one has ever promised that if you have a lower income, you will be guaranteed a lower percentage of taxes. Just nowhere in there. In fact, when we look at income tax history, we see times where the lowest brackets have had noticeably higher taxes than what they're experiencing today. With that being said, though, we do want to make a good, well-rounded comparison here to say if the taxes did go down, you actually benefit more by having this money stay inside of the tax-deferred account, even though this bucket's been growing tax-free since it started. Okay, so again, what we're looking at is how do you benefit the most from getting the most money to stay with you as possible. Now, when we look at this, I think for most of the people that we talk to today, there is I would say, significant chance that taxes will increase. Now, that's not a guarantee. Obviously, a lot of things can change, but based on the overspending that's happening in Washington, couple that with the massive amount of debt that's been built over, several decades, but really ramped up over the last decade, I think there's a very high chance that taxes are going to have to go up, not mentioning Social Security and Medicare issues where they are improperly funded. As we look at that, I think that's going to result in affect the balances of people that have IRAs and 401ks, because when income taxes go up in this scenario, that leaves you with less money at the end of the day than if you made those tax decisions when the tax bracket was smaller. So what we don't know, full disclosure here, is when those tax brackets are going to change officially. I'll talk about what's on record right now, but things in Washington don't always happen according to whatever is the rules at this time. That could change depending on who's in power. But then also we don't know the extent that that tax increase is going to have. So since we don't know that, we've got to look at where we are today, but also history to give us some insight of what that could be. So as we look at this for this single individual, as we said today, they are in $65,000 of income, which would put their top dollar in the 22% tax bracket. This is today's brackets with standard deduction on top of it. And so $65,000, any conversions would happen at least 22%. As we look at this, 2017, those tax brackets at $65,000 of income would be a little bit higher, 25% tax bracket as we're comparing it. And then 1981, as we see here, this is a time where it's really the last time that the top bracket was noticeably higher than what we've gotten used to. As you notice here, 70% is the top compared to 39.6 or 37%. So almost double where we're at today. And really that starts to ramp up once you start going much above $75,000 of income, because these are all adjusted for inflation to today's income, not the dollars as they were in 1981. So as we look at this particular individual would be in actually the 24% tax bracket, which is maybe one of the first videos that I've done where their percentage in 81's brackets is actually lower than their percentage in 2017. So I didn't initially plan it that way, but that's the way things happen. Now, what we want to factor in also into this is this person's going to work another 3 years, and then their income is going to drop pretty drastically, because they're going to go from $65,000 of income to $48,000 of income, and of that 48, 30 of it is not fully taxable, because Social Security is at most taxed at 85%. So again, if we're being conservative, we've got 85% tax there. What that means is that's going to have, what, $25,500 of tax on that $30,000 of taxable income. You add that to the 18 that they need, that's going to give you, $43,000 of income. So as we look at these brackets, that's going to put this person in the 12% bracket where they were in the 22 at retirement time. Also at retirement time, if things went from 2017, and I missed this, but 2017's brackets are what are set to go in place if our tax code now expires after the tax year 2025, which is what it's set to do, and it reverts back to this in 2026. So obviously they could extend it, they could ramp up the tax brackets, or they could do this. But since this is the only thing that's been said and the way things are, we use this as a number that we count to. So, so again, $43,000 of taxable income, your top dollar of conversion would be at 15%. And then going to 1981, you would actually be at 16% for your top dollar there. So as we look at this, today, this person is in the 22% bracket. If their income stayed there for retirement, they would be at either the 25 or potentially the 24. So you're looking at 2 to 3% worse than where it is today. But when retirement happens, that income is going to go down in a major way. And none of these numbers are higher than any of these numbers. So as we look at this, my recommendation is actually not to do any Roth conversions today, which again, sometimes that happens, but that doesn't mean we don't do anything in the Roth, because the advantage here is to do how much into a Roth, and we want to do this into a Roth 401k if this person has this at their disposal. Because what's good about a Roth 401k, you can make your contributions into it just like you can a regular 401k. This person being over 50 years old can actually put this year $30,000 of their income. And so if this was one of our clients, we may actually recommend them do that and start living off of some of their after-tax savings so that they can, really be able to ramp up some tax-free money in those accounts. And so as we look at this, if they did that $30,000 to the T, what they would have is, based on the brackets as they are, and again, going back to standard deductions, their $65,000 of income, up until 58 of it would really be taxed at a maximum of 12%. And then, they would get into 22% with a portion of it. So what that means is if they fully maxed out their Roth 401k, not counting any contributions that typically get matched inside the traditional side of the 401k, but they would have a little less than $7,000 taxed at 22. They'd have $23,000 that would be taxed at 12. And again, I think paying tax for this particular situation still makes sense at 12% for sure. So somebody may stop at 12 and not do the 22. Even when you do this, it's an effective tax rate of 14, which I still feel like is a good deal compared to where tax rates could go in the future. So as we look at this, sometimes when we have this discussion, it may not be doing a conversion that goes on top of an income, but it may be saying, okay, we know we're going to show this much taxable income. How can we maximize that with contributions into a Roth 401k? And then, this person could potentially put another $7,000 into a Roth IRA outside of the 401k. So as we look at this, there are many ways to maximize this. There's many ways to do this. This is why this has a level of complexity where watching a video is not necessarily the only thing you need to do. You need to talk to somebody, make sure you have all of the things understood about your situation. But what I tell people all the time, if you've not heard at least this much about tax planning for your unique situation, you need that kind of help. I mean, it's just, that is maybe for some of the people we talk to the most advantageous thing we can do today to help them really get a step forward in their retirement years is by really maximizing the savings that they already have and making sure they pay the lowest taxes, considering what we know now that they can. So if you've not had that type of advice, we would love to sit down with you, see if we can share that, whether it's a phone call, Zoom meeting. If you're close to Tennessee, obviously you can come in person, that's where we are. But you see the link there that's listed in the description on this video, also may pop up on this video. Click that, schedule a time where you can sit down and talk over your situation with us. We'd be happy to do that. We are fiduciaries, which means we're going to put your best interest forward in the recommendations that we give. And again, back that up with numbers and make sure that we're having a well-rounded conversation. So hopefully this was meaningful information to you. Oh, one last slide. This doesn't apply for this specific situation, but since this is a 63-year-old, we never want to miss an opportunity to talk about this being the first year where any increases to your income would affect the Medicare costs that you would have 2 years later. So again, this person's only going to show $65,000 of income, but you need to be aware of these things, as we said, of all the factors that go into this discussion. You need to be aware of these. This is for single person, married couple, doubles most of these, except this number that goes to 750. But again, this could be an additional cost that you need to factor into that Roth conversion conversation. Like I said, that'd be something we'd be happy to do with you. So hopefully you enjoyed our time today. Again, if you've got questions, fill out a comment, subscribe to our channel so that you can get more of these videos. And we look forward to sharing more information with you in the future.